Half an hour away from the open in Hong Kong with mainland markets still shut for the holiday. You're watching the China show. I'm Yvonne with David Ingles.
Happy Friday. Our top stories as we wrap up this week. Oil extending gains as President Biden fuels uncertainty over the Middle East conflict, saying an Israeli attack on Iran's oil facilities is being discussed. Now, those tensions are putting equities across the region under pressure ahead of the U.S. jobs report. Now, Hong Kong markets in focus after the slide we saw on Thursday, with questions over how far China's stock boom can go further. And the EU is set to vote on proposed tariffs on Chinese EVs, with Germany reportedly set to say no and Spain seeking a compromise.
A look at the price action on this Friday morning as we wrap up the trading week, the first really trading week of the month. And certainly we've been roiled with a lot of these Middle East tensions that really are, I guess, overshadowing what we could be seeing later on, which is that jobs report out of the U.S. So right now we talk about the gains that we're seeing when it comes to crude markets. We're extending this rally after that 5% pop that we saw when it comes to WTI and Brent here this morning. So, yes, we're at 1 month highs when it comes to oil. Gold futures are watching very closely, just given that geopolitical sort of hedge, but also some cross currents there. The fact that we've seen the stronger dollar, also that lift in real yields in the U.S. as well. What we're watching very closely is stocks are slightly in the back foot here today. Taiwan coming back online after that 2-day markets were shut because of that typhoon. Looks like pretty slow going, but we're looking to see if there's any sort of catch up there. But really, it's only markets like the Kospi that are seeing a decent bid here this morning. Treasury yields also have been kind of steady after we did see yields pick up on the back of that ISM data that we got that did show strong when it came to the data as well. So what does this mean for the U.S. jobs report? Could be a pretty crucial test to bond traders here, and whether it does solidify this debate about whether we'll see a 50 basis point cut from the Fed in November. That has been trimmed down quite a bit in just the last few days, just given the data as well. You take a look at how some of the oil markets are doing, and obviously we're watching very closely, not just Brent, but also when it comes to China futures, which are following the moves that we're seeing when it comes to WTI as well as Brent. We're up some 1% for Shanghai crude this morning. The energy sort of stocks is catching a slight bid here. You're looking at stocks like Woodside Energy in Australia that is up about 1.5%. And also, many are saying, look, we're maybe on course for maybe $100 oil. That's what some options markets are maybe pricing in here right now. But we're still talking about one of the best weeks for oil in 19 months. If you take a look at when it comes to the China Open, obviously the slippage that we saw in Hong Kong is what we're watching very closely here as well. Some say it's healthy. Will we continue to see that sort of profit taking here today? Futures suggesting possibly so here. And really, the real test is going to be once we get that holiday spending data. Citi had a pretty interesting call saying, look, things look pretty resilient. There's been a few upside surprises. We'll unpack that in just a bit right now.
Yeah, and we'll see what the market reaction will be to some of these high-frequency numbers and notes coming through from analysts. Mainland markets, of course, remain shut. That's a story we'll be looking ahead to, of course, on Tuesday. Yes, we did see a decline in Hong Kong stocks, although the direction of travel and the momentum still certainly behind the bulls here. In fact, for the first time in, I think, several months, we're back above the 200-week moving average on the Hang Seng Index. We'll get you a chart on the specific levels to watch in terms of support levels. We talked about this EU vote on Chinese tariffs, something on the agenda for later on Friday. Energy stocks on the back of the move we're seeing in oil, plus, of course, anything around EVs as well. Right. Now, on this very note, we're looking at oil, of course, on track for the biggest week in about nearly 20 months.
Yep, and Israel is pressing ahead with its campaign against Hezbollah in Lebanon. And meanwhile, President Biden has fueled uncertainty about what could come next as the world braces for Israel's retaliation against Iran.
Do you support Israel striking Iran's oil facilities, sir?
We're in discussion of that.
Let's bring in Bloomberg's news desk editor Jill Deesis joining us now. Before we get to those comments from Biden, what would some sort of counterattack look like, you think?
Well, at this point, I mean, this is the idea that Israel could potentially weigh a number of measures, including attacking, obviously, energy facilities associated with Iran. The most extreme measure would be nuclear sites, which I will say Joe Biden said, a couple of days ago, look, I wouldn't support that. I think that's also what's bringing these most recent comments from Biden into questions, because it's this idea of, all right, well, where in the spectrum, where would the U.S. or would the rest of the group of seven ultimately support Israel as it kind of weighs some of these retaliations? We've obviously seen just this week ground incursions into Lebanon to attack Hezbollah targets. We just saw that overnight with these most recent bombings. What would a counterattack look like in Iran? There's any number of measures that you could take, from firing against weapons facilities, that kind of thing, all the way up to more critical energy supplies. That's pretty much where the conversation rests right now.
Yeah, and that soundbite we played from the president just there possibly said a whole lot without really saying too much. And I'm wondering how we're set up going into this weekend right now, where, to your point, there's a varied number of options on the table right now that market should be looking ahead to here.
Yes, that's right, David. And yes, I mean, these comments were ultimately still kind of cryptic. I think obviously what you're seeing with the reaction from the oil markets is that traders are really looking at this and trying to glean what they can from what Joe Biden said, the full quote being, we're discussing that. I think that would be a little anyways. And he kind of loses a thought there, or doesn't, say the full thought there. Again, it just really does stand in contrast with more of this categorical refusal earlier to support Israel attacking nuclear sites. And so that's when you're again, bringing this into the category of, well, what does the U.S. support in terms of an appropriate retaliation? We've already seen over the past year, the U.S. and its allies, Israel's allies, kind of trying to pull it back from a major escalation of a war in the Middle East, sort of unsuccessfully in many ways. Now this is a really, really critical period where we've seen so much ramping up by Israel against, Iran-backed forces, in Lebanon, elsewhere, with very, very limited success, if no success there. This is a really, really critical period where we're seeing that kind of escalation from Israel. We'll have to see what that looks like going into the weekend. But yes, a lot of uncertainty ahead here.
Yeah, Jill, thank you. Our news desk editor. I just have to correct myself here just now. Oil markets in China are shut still, so don't ignore what I just said.
Yeah.
When it comes to what the futures are doing.
I mean, the price did show up. If they were open, they would be up.
They probably would be reacting.
They're probably reacting as well.
My bad.
Well, I mean, with Brent prices at 78, 74 right now in West Texas, 8% week for oil prices. Where do we go from here? Have we fully priced in the risk? Do we know enough what to discount over the next couple of days or so? Let's bring in our senior energy reporter, Stephen Stapczynski, joining us out of Singapore. Stephen, your thoughts on the future direction of travel here for oil prices from the current levels? 5% move, of course, going into Friday.
Right. So Brent is around $77. We were at 70 before all of this began last week. But, I don't think the market is still pricing in a strike on Iranian oil infrastructure. I think that there is this war risk premium coming up, and people are unwinding their bearish bets. There was a very big bearish, movement in the market. It's oversupplied. The fundamentals don't look so great for oil. So it'd been on a downward track. And of course, now with this happening, people want to get rid of their shorts. So you saw that uptick, and we're nearing $80. I think that will be a symbolic level if they're able to get above that. But the market is watching for a few things. One, will Israel really hit Iranian oil infrastructure? If they hit export facilities, that can take 1.5 million barrels a day off the market. That's about 1% of global oil supply. That's not nothing. That's a pretty significant amount, and you could see oil prices rise further. An attack on other infrastructure could maybe take out 400 to 500,000 barrels a day, according to Citigroup. That would be smaller, but again, that would show a ratcheting up. Now, a worst-case scenario, while it's not oil, would be an attack on nuclear facilities, because that would show just an overall increase in the rhetoric in the region. It risks spiraling into a further all-out war, because those nuclear facilities are so key for Iran and the government. If they see that happens, then the retaliation in that region could increase. And that's when you start talking about oil prices really surging. So those are the scenarios that traders are carefully watching. But as indicated just earlier by Jill, there's a lot of uncertainty. No one knows what's going to happen. And Biden's comments just add to that uncertainty, and it just creates more volatility for the market.
Yeah, and not to mention, the market is still grappling with weak demand when it comes to oil, Steve, I have to wonder then, does OPEC have anything, how are they thinking about this? I mean, this is, of course, they're thinking about reviving actually output as soon as December here. Do you think that changes the calculus in some way?
I don't think so. OPEC and Saudi Arabia, the de facto leader of OPEC, they've been pretty clear that they're staying out of this geopolitical situation. They're looking purely at the supply and demand. And the supply and demand situation, according to their analysts, which they reaffirmed in a meeting just earlier this week, is we're going to increase our output from December, adding about over almost 200,000 barrels a day to the market, and then continue those output increases into 2025. So right now, the increase that we're seeing in prices is not driven by fundamentals. It's driven by fear. And so what OPEC Plus is doing is saying, let's strip that away and look at the supply and demand. We're going to add more. And some analysts are saying that OPEC Plus is actually adding too much to the market, and they could kind of cut some of that back. So how do you play that situation? It's challenging for them, but it is certainly something that the market is taking very seriously.
All right, Stephen, thank you. Stephen Zepchinski there helping to clear out some of the speculation. I mean, some people calling for $200 oil if we do see some damage to infrastructure in Iran, but certainly we'll continue to watch this developing story. And still ahead, we're going to look at how investors are really juggling these Mideast tensions with signs of a healthy U.S. economy. And really ahead of today's payrolls numbers, we have more from Wealth Enhancement Group's Nicole Webb coming up next. And we're counting down to the open of trade in Hong Kong. Of course, mainland markets are still shut on this Friday morning, and looks like we could be still ending this week when it comes to Hong Kong stocks, a third straight week of gains. Futures are lower, though. This is the China Show.
It's Jobs Day, and Bloomberg has the report under surveillance.
Markets pay attention to one thing at a time.
It's all about that wage data.
Wages are stabilizing, and that's good news for the inflation story.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Are we losing dynamism in this labor market?
We don't have a jobs problem at the moment.
It all comes down to what the data says. How important is that payrolls data going to be?
The September jobs report, today on Bloomberg.
Welcome back to the China Show. The U.S. set to release jobs data for September, and really the estimates are just showing some strong job growth, and of course that unemployment rate. It is set to be steady at 4.2%. Obviously, if you watch that unemployment rate, if it starts to tick higher, that certainly could lead to some volatility across these markets here. But we're talking about 150,000 jobs that could be added for the month of September. But yeah, as Bloomberg Economics, as Anna Wong says, you look at this data, yes, it might show solid jobs, but there is some reason to caution against what Jay Powell has said is a strong labor market.
Yeah, very strongly worded report there, and I strongly encourage our Bloomberg clients to check that out, of course. What Anna and her team have done is they've taken the data sets and they had to look underneath the hood. And three of the specific data sets that they think the Fed uses, they unpack that and say, underneath the hood, things don't look very good. So we'll probably get a strong jobs report. That doesn't mean the labor market is strong as well. But that being said, the Fed's cutting, so how does that, offset things moving forward? There's that. There's the oil story going into the weekend, plus, of course, where we are with this out-of-nowhere Chinese rally that global investors might need to start discounting as well. To talk about that, Nicole Webb is with us, Senior Vice President and Financial Advisor at Wealth Enhancement Group. Nicole, a pleasure to have you on the show, and thank you for making the time. Why don't we start with Middle East tensions, because certainly in the oil markets, things do look fairly concerning. The equity market, though, doesn't seem to be budging. Square that circle for us.
Yeah. It's really interesting in the trading session today in the U.S., so end of day Thursday, oil prices moved quite a bit higher, but the market didn't overly respond to it. And so as we continue to see escalating tensions abroad, we're not really seeing much of a contraction in equity markets. So we have seen the VIX, or the volatility index, rise above 20. I think what this really points to, though, is that the markets are brushing most of this off under the under the headline that the economy is good and the Fed is moving towards normalization of rates, which we know. But then as you kind of go even further with it, you're actually having some of these kind of benchmark revisions that point to higher corporate profits, lower labor costs, savings are still really good. And so there's just this really strong growth story that's omnipresent in the equity markets in the U.S.
Why do you think the markets are still pricing in possibly another 50 basis point cut by the Fed then, if the data remains strong? I mean, should we actually maybe damp our expectations now that the Fed can continue to front load these cuts?
Yeah, right now the market's pricing in 70 bips of cuts between now and the end of the year. Though I say conversationally, we think more about 225 basis point cuts. And so, Fed Powell did reiterate this week in an interview that he felt like there was ample room for cuts, so that if there was any surprise to the job market, so kind of correlating this back to the jobs report we expect first thing tomorrow morning, if we were to get softer numbers than expected, that does throw growth into question. If growth is thrown into question, I think that's where you really start to see the equity market respond. And that's where we can then start to think about the Fed accelerating the pace of cuts. So perhaps a second 50 basis point cut is on the table next. I also think that if oil does spike, so we're starting to hear some of these analysts talk about $100 a barrel oil, that does also catch the Fed a little bit off sides. And it begs that question, does that trickle through as inflationary? And so, it's not that we're on a clear, perfect path to this Goldilocks scenario. But as long as productivity remains strong and earnings remain strong and earnings forecasts remain strong, I think you continue to have this backdrop of growth.
Okay. Well, would the investment sort of thesis overlay then be definitely overweight equities over fixed income?
Yes and no, actually. We have this expectation that as the Fed continues to cut rates, we start to see money leave money markets and head into investment grade bonds, and that we expect that investment grade corporates could actually have a really good run from here. But overall, yes, we do believe that we are in a secular bull market, and that if broad support comes from spreads in and rates down, then it's a no-brainer that we both have strength and a broadening in this market that continues to chug along for some time now on the basis that companies can reinvest going forward.
For the equity market, though, I mean, you mentioned how the U.S. continues to be near these records here right now. The signs of the strength is broadening out. Do you think that is sustainable? And does it need, though, tech to reassert itself to kind of drive this market higher?
Yeah, I think there's two things there. Number one, the first, you haven't really felt the full impact of the normalization of rates or the cutting of rates. And so there's aspects of the market where, as credit card rates come down, we start to see more confidence or the loosening in spending in our lower income consumers. Second to that, we are under supply in housing in the U.S. And so as rates come down, we do expect housing starts to pick up and that area of the market to really be a growth engine of the economy. Second to that, though, is going to be technology. And while the S&P 500 hit new all-time highs without leadership in technology, likely to reach the next set of highs, we do need technology. Now, we heard from Jensen Huang this week that, the demand for his product line at NVIDIA is insane still. And as long as the hyperscalers continue to spend, we look at NVIDIA at 30 times next year's earnings, not as a crazy valuation on some of these names. And so we do think there's room for technology to bring us a leg higher on the S&P. But first, we have to get back to those September highs in technology.
Right, which we've yet to see. I think certainly we've been in a fairly tight range as far as NVIDIA is concerned. Just to push you on the NVIDIA call you just mentioned, is that a call, Nicole, on NVIDIA, or is that a call on AI more broadly? Because I guess to some extent, we sort of have to be almost nuanced in which AI play one gets into.
We really should. I just called in just the valuation in which NVIDIA is trading at, but we do think that NVIDIA has a bit of a moat around itself. We do think that the partnership with Accenture just kind of shows the strength in how fast business adoption is going to take place. And to that point, though, we also do believe that the semiconductor space is one where we're going to continue to see growth. And as we know, under this thesis of the creation of sovereign production of chips from a global perspective, we just do believe that both chips and the byproduct of chips continues to be not only incredibly necessary in insane demand, but that there is the future component of conversion to that investment really paying off. And so we don't think that there's an incredibly long lag time between the hyperscalers finding that next leg of revenue.
And Nicole, I was just going to ask your take on just being based in New York, how you're looking at these Chinese assets right now, just given what we've seen in these ETFs in the U.S. that are basically seeing inflows once again. We're still trying to figure out how sustainable it is, but is this market something that is harder to ignore now?
It's certainly harder to ignore. I think the curiosity, and I will preface this by saying I don't cover China, but obviously it has been the makings of a big part of conversation this week. The curiosity remains around this: is the stimulus enough for the Chinese consumer? So is the stimulus being put in the right direction? Yes, stabilization of real estate is important, and the rest of the world looks to the Chinese consumer. And we've seen that play out in the S&P, whether it's looking at the fall off in demand from everyday accessible American luxuries like Estee Lauder, Nike, Starbucks. And so there is a huge kind of flow through to global markets that really happens on the back of the Chinese consumer. And so we're sussing through kind of what this stimulus does, and if it's stimulus that kind of helps more broadly, or if it's a bit more specific to pockets of China.
Nicole, thank you so much for joining us as well. Have a great weekend. Nicole Webb there, Senior Vice President and Financial Advisor at Wealth Enhancement Group. We're taking a look when it comes to your pre-market in the Hong Kong market, and there you go. We're seeing a bit more downside, so extending some of those declines that we saw yesterday. We're still hovering that 22,000 level for the Hang Seng. Dollar China, 705 levels here. We got plenty more ahead. This is Bloomberg.
Right, welcome back to shows. A couple of minutes to the opening bell here in Hong Kong. Mainland China is still shut. We are still on track despite the losses we'll probably see in the opening minutes here for a third weekly gain. As far as eco goes, S&P Global PMI for Hong Kong coming in an hour back at 50. So we're back at that level for the first time since early this year. So lots of encouraging things going into the Friday session.
Yeah, if you take a look when it comes to what we're looking at, analyst action, Citi had an interesting note when it comes to some of these consumption-related stocks. So appliance makers, which they are upgrading now, Agree Electric raised to a buy, Hisense Visual, Roban Appliances as well. Separately, Citi also coming up with a different note talking about the Golden Week travel, resilient, but few upside surprises. So something to keep in mind as they start tracking some of these data like passenger traffic, the like. We got the open coming up next in Hong Kong. This is Bloomberg. Welcome back. You're watching the China Show. We're counting down the open of markets in Hong Kong. Of course, mainland markets are still shut for the Golden Week holiday. And the big question is this rally now fleeting? You take a look at the analysts and what they're saying now. There's still a bit of debate about how long this rally can go. We'll talk about that in just a little bit. But yes, we are seeing a little bit of slippage here in Hong Kong as we wrap up the trading week. But we're still on course for a third week of gains in Hong Kong, Dave.
Yeah, I mean, despite the losses we're seeing so far, so it was about a 3-4% drop, a half of 1%. We'll see what Friday looks like. I mean, the chart still looks vertical, right? We hit 14-day RSI of 90 on the Hang Seng Index before the pullback, which was largely expected anyway, given how quickly things have gone. So we'll see, what levels to watch. I mean, moving forward, of course, into next week, it's a reopen in mainland China, and at some point, we'll need to see some of the earnings come through, and some of the details, of course, around some of the initial stimulus measures that were announced over the past several weeks or so. 22,000 on the Hang Seng Index right now, a third of 1% to the downside. as Yvonne is pointing out, a third week of gains still at these levels. It's going to be it'll take a really bad day to put that statistic aside for now. Now, all that being said, we're also looking at a couple of PMI. I forgot to talk about that. About an hour back, of course, the Hong Kong PMI for the month of September coming in at 50. So that's quite an improvement from the August numbers as well. So I guess in terms of the data flow and maybe some of the tourism flow, which we can talk about later on, of course, certainly supportive of the rally even further. Retail sales, though, coming in worse than expected. A couple of things here. So as you can see, some of the big stocks are trading lower. HSBC, the story here is, you might have read about it, sources are telling us that, the bank is looking to pare back the holding of some events. I think there's one big one in India that's no longer happening. And some of the some travel, not all travel, of course, to curb some costs here. A couple of other things to note. This big move up in oil prices overnight. The next board is going to show you your big oil plays in China, everything CNOOC, PetroChina, Sinopec, China Shenhua on your screens. Move up against the grain. EV makers also in focus. This vote, of course, in the EU, something to look ahead to as well. So you have BYD, XPeng, NIO, and Great Wall Motor. Among some of the names there, NIO is down about 4% in the early goings. Very quickly, back to the big story, which is really the support levels to watch, given how far we've come here on the Hang Seng Index. I'll make this very, very brief. This 300-point region on inside that blue square you see. So the purple line is your 200-week. It's a weekly chart moving average. That's one to watch. Below that is your retracement level, 38.2% Fibonacci, if you take the peak to the 2022 lows. So around that region are levels to watch. You know, we've certainly cleared those levels, so we'll see what happens. We're currently, as things stand, about 500 points, Yvonne, north of the top end of that range. So we'll see, and maybe if we take that out, then the bears have something to talk about. Yeah, and the bears are already coming out in some ways, right? When you talk about what Nomura's Ting Lu is saying, you know, he's always been quite bearish, but he says, look, this rally has reminiscent of what we've heard from 2015. This is Rajiv Jain from GQG as well. You know, he's also saying, look, I'm not that impressed by this stock market mania that's sweeping the globe right now. How many times in the last 3 years has this happened? If the party goes on without us, that's fine, he says. He's fine staying on the sidelines of this here right now. Ting Lu as well saying, look, it feels more like the boom and bust of 2015. We know what happened then, and the crash that came following that. And he thinks there's a much higher probability than that, than actually the more optimistic scenarios here. So he says, look, it's great that you're indulging in this now, but you need a bit more of a sober assessment in maybe in a few weeks or so. Yeah, so those are the two views to the downside. HSBC, they're coming out on the opposite. Yeah. In fact, in their case, lifting onshore China to overweight, which is, of course, where most people think the bulk of the gains remain still. I think Morgan Stanley had a note. Laura Wang. 10% upside still. CSI 300, yeah. And it's interesting with HSBC because they've been talking about, these stocks are about 15% undervalued based on just fundamentals alone. Right. So right now there is still some room they're talking about for more upside here. And right now, it just seems like what's funding that trade is that they're downgrading some of the EM plays, like Mexico, for example. Yeah. So let's get the take now from Jimmy Chen, portfolio manager at Comgest. He joins us here in our Hong Kong studios. Is it too late to enter this rally now, Jimmy?
I think over the medium term, it is not too late. I think in the near term, obviously everyone's waiting for the national holidays to be over and for the next few weeks to see what kind of fiscal stimulus that everyone is expecting will be announced. But if you look at the valuations, how undervalued it is, the entire index is, versus international equity, and you think of how much of the negative news expectations have been built into Chinese equities over the last few years, and more importantly, how detached that is from what the fundamentals on the ground is actually like. I think there is significant support for a longer-term rally. The fundamentals are actually quite good, and everyone's worried about, especially near-term, some macro cyclical slowdowns, but the structural forces are still with China. It is the largest economy in PPP terms, the second largest in USD terms, It is the largest industrial manufacturing country in the world, with 35% of total share. And those manufacturing, and both of those stats are still increasing. So China, even at 5% growth, is still gaining share in terms of global GDP. And it's not just from quantity, it's from quality as well. We've seen that with the innovations, we've seen with the DEVs and the solars, etc. So the fundamentals are set up for a very strong long-term rally.
Well, let me push you at that. If the fundamentals are in fact as solid as you say, why then the extraordinary set of stimulus and measures and that rare briefing from officials that they had to come out with?
So there are certainly issues on a macro, on a demand front, on the aggregate demand front. There is a lack of consumer confidence. There is a lack of, partially from the property prices declining, leading to negative wealth effect. That is a demand issue. It is a cyclical issue. And like all economies, they go through cycles. I think people forget, partially because China has been on a tear-away positive growth trajectory without very visible cycles, so to speak, on the demand side for so long. But as GDP per capita reaches higher levels, as you go towards what Taiwan, in terms of wealth, per capita wealth, per capita income, towards where Taiwan is, where Korea is, you will start to see cycles. And we are seeing some of that. So you need counter-cyclical measures, as mentioned in the Politburo statement. You need counter-cyclical measures from fiscal and monetary side to counter that. But the long-term question for China is whether it can hop over the middle-income trap.
Yep.
And the key to that is whether you are generating enough productivity gains, enough value-add gains. Are you moving up the industrial value chain?
Yeah.
And all of that we've seen in the last 5, 6, 7 years is on a positive trajectory. I think 7 years ago, when China first reached $10,000 per capita income or per capita GDP, there's a big question on whether China can hop over the middle income gap. I don't think that is in question anymore.
We talked about those comparisons. Some say this rally to 2015, even the COVID reopening from a few years ago. Is this time a bit different because you're hearing that there's a bit more state support, and the PBOC talking about these swap and relending facilities, that at least there's new capital tools that are being put to support this market?
So completely right, Yvonne. So there has been quite a number of false starts from a policy perspective in the last few years. There's a saying in Chinese, managing or governing a large country is like cooking a delicate dish. And I think the Chinese government take that to heart quite a bit. So you can see from the policies, it's always a bit of a push, a bit of a pull. Right? It's never gung-ho, all in, like back in 2008, from which they learned a big lesson of not going in that kind of faction. What we've seen the last week, from both first the financial regulators coming out, followed quite rapidly by the Politburo meeting, and also the tone of that meeting, it seems to be that the willingness to impose a stronger fiscal stimulus is stronger than before. So we're cautiously optimistic. Some of the critical messages or wordings that you will see, looking at is, for example, on property prices. Ever since President Xi Jinping has come into office, the tone has always been houses are for living in, right? Not for speculating in. And therefore, he did not care so much whether the house prices decline. But the tone in the last statement was, it's time to stabilize housing prices.
The markets rallied substantially. In fact, if you sat on an index fund, you wouldn't need to do anything, and you'd wake up 3 weeks after you're up 30%. How are you looking at this? The rally at this point. What are your biggest overweights, for example? And are you sitting on your portfolio? How have you adjusted to this sudden change in reality in the last 3 weeks?
So we are a relatively long-term investor in China. So we have been almost fully invested for a while, and it has been a very short but very sharp rally, and we've been assessing how we're positioned. So far, we haven't made any changes. It's pretty clear that the immediate winners from the rally would be. You've already seen it, right? It's the properties, it's the discretionary consumptions that have been hit quite hard in the last while for obvious reasons. And there's also the areas where the government want to stimulate on. There's also the internet sectors, which has lost faith from international investors for a while. But there's still major components of the index. But if you look longer term, or even the medium term, I think we like sectors where there is still structural growth. So China is transforming. So at Comgest, we like to say, or we see China is transforming. So there are certain sectors which are not going to be how they have performed in the past. Property is a good example. So even with this rally, and if you look into the wording of the Politburo statement, even though the government wants to stabilize the housing price, they don't want the supply of new housing to go back up to 2020, 2021 levels. That's basically telling you that housing, from a volume perspective, the developers, from a volume perspective, that market is pretty much capped. And it remains a capital-heavy business. It remains a low-return business, very high leverage. So that's not a sector that we haven't been in that sector for a long time, and it's not a sector that we like for the future either. Compare that to consumer discretionary. So Chinese consumers, their taste are transforming. They, instead of preferring foreign brands like the Nikes and the Adidas, they now increasingly prefer the domestic brands like the Antas and Li-Nings. And they are having a bifurcating type of demand. So instead of their interests are expanding, they are now more interested in traveling experiences. In sports, they are now actually doing cycling and marathons, things that you wouldn't think about 10 years ago.
That sounds like a Middle East crisis, though, than a changing of preference. But go ahead, sorry.
Cycling is especially interesting because thinking back 30, 40 years ago, when I was growing up in Shanghai, you had these swarms of bicycles in China, right? And they were relatively cheap modes of transport, but it was just transport. Who would have thought that within one generation has gone to become you'll pay 20,000 for a road bike and use it as a form of entertainment and exercise.
Jimmy, final question very quickly, if you can. The market will sustainably rally if we get the big institutional investors coming back into this market, the incremental buyer, right? Those who have been in China have been in China, like yourself. It's really bridging that conceptual gap between the foreign investors who've stayed away from the market. Have you seen a pickup in interest from foreign investors coming into your fund or your peers, for example, the last 3 weeks?
We're seeing some interest. We've actually seen small inflows. Know that our clients are usually quite long-term themselves, so they usually wouldn't respond as quickly to this type of a rally. So it's actually surprising to us that we're seeing small inflows as a result of that. Actually, we've also seen some inflows before the rally in the last half a year to a year or so, where I think they've decided China is too cheap. And again, like I said, the fundamentals are actually still solid. So I think at this point in time, especially for the long onlys, the foreign investors, they're not switching that much yet. I think they've seen the rally. They probably want to play the rally, but their view on the China fundamentals, I think, is still quite negative. But foreign investors is not the only capital that can enter the market. Domestic, there's a lot of savings in the Chinese banks. It has grown phenomenally in the last few years because the consumers stopped spending as much and they just saved. But the income was still rising. They saved, right? And they've stayed out of the market for a number of years because the market has been weak. That money may come in, and I think, again, from the Politburo statement, they actually want a stronger domestic equity market in the long run.
Jimmy, fantastic. Have a great weekend ahead. Happy Friday. Jimmy Chen there, portfolio manager at Comgest. You can get, by the way, more on this story at Insider's Guide on mainland China and, of course, here in Hong Kong, our Hong Kong edition newsletter. In fact, the one that was released just yesterday talked about who needs a holiday when you have stocks that are on fire. Check that out on your Bloomberg terminal. It's on the website, bloomberg.com/newsletters. Plenty more ahead. You're watching The China Show. Good morning. Right. One of the major items in the agenda this Friday is this vote in the EU, and member states they're preparing to choose and effectively give their vote, of course, on imposing tariffs of as high as 45% on imported EVs made in China. Min Lo, our China correspondent, is here with us to give us a preview how the vote could go, and if we do get a yes, what the impact would be.
Yeah, it's hard to say right now, but I would say that we have never seen any EU trade measure being overturned in this way before. The bar is very, very high because China needs a qualified majority of 15 EU member states, making up 65% of the bloc's population, to oppose this vote. We know that Spain and Germany are two countries that may, say, abstain or vote against the tariffs, but Reuters previously reported that Poland, Greece, Italy, France could vote in favor of the tariffs, and that is probably enough to get those tariffs through. Although we know that ahead of this vote, there has been a lot, very intense negotiations that's been going on, sometimes almost daily as well, to try to avert these tariffs. China has been in talks with the European Commission to come up with some sort of price control or volume control to address some of the EU's concerns, but it's not clear now whether there is any breakthrough on that front. And I guess if this vote goes through, both sides have said that they will still continue with those talks. So we could see things change further down the line as well.
All right, Min, thank you. We'll watch out for that vote later on when, of course, Europe wakes up. Our China correspondent, Min Lo there. To our Bloomberg scoop here right now, HSBC is said to be canceling some events and further curtailing travel as the bank's new CEO seeks to keep a tight lid on costs. Let's bring in our Asia investing editor, Russell Ward, with more on this story. So, Russell, we have seen the new CEO really kind of make at least cost cutting one of his priorities since he started the top job. I'm just wondering, what's on the chopping block this time around?
Absolutely, Yvonne. Yeah, this is really the latest evidence that cost-cutting is definitely a priority for new CEO George Al-Hedari. He's only been in the job for a month, and already we've seen growing signs that cost-cutting definitely is a priority. So the latest that we're hearing is that staff are facing travel restrictions. Even some senior managers are having their overseas trips cancelled or postponed. And also the bank has been cancelling some summits and some internal events. So there was one summit that was scheduled to be taking place in India. That is now no longer happening. So really, this is showing that cost-cutting is a priority for Al-Hedari. And really the backdrop for this, of course, is the fact that there's a likely slowdown in lending revenue as interest rates fall, margins are falling. So there's a pressure on profit there, and that's really putting pressure on to cut costs at the same time.
Yeah, Russell, what more do we know about which specific events might be on the chopping board, looking at the months ahead? And also, how much travel is actually being curbed here? Because this is, of course, a client-facing business.
Yeah, absolutely. Well, he did stress, or from our reporting did show, that essential travel will carry on. So it's not like the managers won't be, jetting around for that sort of travel. Don't have too many more details on the other events that are being cut. But really, this is, just sort of showing that Al-Hedari is putting costs in focus. We've already heard that, he's addressed staff in Hong Kong after he took office last month. Gave a town hall there saying, don't necessarily cut spending, but be very wise in how you spend. And so this is really part of it. This is going to filter down through the organisation. And really also it's just a continuation of his predecessor. It's really nothing new, in fact. Noel Quinn was also known for his cost cutting, and his predecessors as well. This is a bank that has cut 50,000 jobs in the past decade. And so, with all of that low-hanging fruit, has already been cut. They're looking at these minutiae, the everyday expenses, and trying to eke out savings like that.
Yeah, I think Bloomberg Intelligence is crunching the numbers too. I think it's $2 billion in cost cuts are needed to actually maintain that profitability beyond 2024. Russell, thank you, our Asia investing editor, joining us out of Tokyo. We got plenty more ahead. This is Bloomberg.
All right, we opened lower. Well, we dropped yesterday, opened lower, and then we reversed all of the weakness, as much as 1.4% on the Hang Seng China Index. We're now trading, as you can see, half of 1% to the upside. So it's looking like there were buyers waiting on the sidelines for a buy in the dip scenario, which we got obviously yesterday. So we'll see how long these things last. We're looking at shipping shares as well. On the back of course, the other story across the Pacific, dock workers, of course, pausing the strike in the U.S.
Yeah. But we're still seeing that slump here. So certainly we'll see how this all plays out. But certainly that's good news that the strike has basically been paused for now. But particularly when it comes to oil stocks in particular, that's certainly the big focus here today, given our top story. But in the Middle East tensions that we're seeing and really following the price of crude, that 5% pop that we've been seeing here. Brent and WTI at least now is holding steady in the Asia session, but you are seeing the likes of Santos is up some 2%. S-Oil in Korea also up some 3% as we start to see more concerns of what a potential sort of response from Israel would look like here. And could it really damage Iranian infrastructure is the big question here today. But as Stephen Sachinsky said, I don't think people are going that far right now to really pricing in that damage for now.
Yeah, it's markets trading on fear, I think is how he framed that earlier on. Going into the next hour of the China show, we're talking all things fixed income with UBP. That's ahead, of course, of the U.S. jobs report coming out. And also a closer look at the investment landscape and a closer look at the private equity market in VC with MSA Capital. All that coming up. This is Bloomberg.
Welcome back to the China Show. Look at the HSI half hour into the session. It's a beautiful day out in Hong Kong as we wrap up this trading week. And it has been pretty volatile in terms of the whipsaw we're seeing across Hong Kong markets, which we knew it was going to come, just given how ferocious this rally was. Eventually, we would have to come and see a bit of a pullback. But then again, you take a look at how things are doing. So after 2 days, we've seen some decent declines. We're back up again, Dave.
Yeah, and if you're still on your way to work, I would argue that the day and the weather maybe trumps this rally. So if you're still on the way to work, maybe call in sick.
Don't say that.
No, okay, sorry. You
Don't
should
be
have
a
called
bad
in sick.
influence. We're here.
Yeah. Well, we need to be, otherwise it's an empty chair. Okay, lots to get into before we talk about the weekend. And you know what? Lots has changed, as Yvonne is pointing in the last 30 minutes or so. We opened lower. We're now higher, as you can see. So volumes are maybe coming back as well. What's happened is, so we know we're 30–40% higher from the bottom here. It's catapulted Hong Kong and China to be the world's best performing equity market. And we'll see what this means, by the way, for fixed income strategies and whether you have any business staying in fixed income and bonds. But Hong Kong is now again a $6 trillion equity market. So we've regained that milestone as far as market cap goes. And we'll see whether or not this spurs many other things like IPOs and listings, for example, which arguably, we were having this conversation a few weeks back, that Midea listing in Hong Kong actually spurred some of the animal spirits initially, and then we did get that big bazooka coming out of Beijing. Right, Asia ex China, we're now a 1/10 higher because of what's happening in Hong Kong. The rest of the region, though, is trading off lows of the day, but as you can see, fairly mixed. Taiwan is back online after 2 days of being shut. We're down to 1% as far as that goes. Of course, it's the U.S. jobs report, which we had to contend with, as well as the geopolitical conversations and the tensions in the Middle East ratcheting up as well. In fact, on the oil story, so we are on track for the best week for oil prices, an 8% move up in Brent, West Texas, and we have almost a full trading day left. We'll see what happens with there. And that's playing out across some of the energy counters, as you can see here in the region. So where do we go as far as oil prices are concerned?
Yep, that certainly is the key question here today. We see oil prices are at least pretty steady right now, following the biggest single-day jump we've seen in almost a year on concerns over tensions in the Middle East. Let's get to our senior energy reporter, Stephen Sachinsky, joining us now from Singapore. In terms of what we're seeing, obviously, there's an escalation in the conflict. And we're watching very much what Israel's response in this counterattack might look like. But what do you think oil watchers are looking out for the most, Stephen?
There are sort of four scenarios that I think traders are watching out for. One, Israel has a counterattack, but it hits no energy or oil infrastructure. Prices will come back down. You'll see Brent, which is around $77 right now, go back down towards $70. It's a bearish sort of situation in the market. There is a supply glut, so that kind of erases the war premium. Now, in the scenario where Israel hits some infrastructure, let's say some refineries, that could cut out, according to Citigroup, 400 to 500,000 barrels a day from the market. That could cause a sustained increase in prices. If Israel hits the export facilities for Iran, that would be about 1.5 million barrels a day, according to Citigroup. That would be about 1% of global oil supply. Then you would see a larger sustained oil increase, potentially testing above $80 towards $90 Brent. Worst case scenario is if Israel hits nuclear facilities in Iran. That would be a sort of an indication of ratcheting up of pressure, and you could see potentially a counterattack or more response from Iran that would be wider, that would affect the larger region. And oil production in the Middle East is about 1/3 of all output. So any other increase beyond a conflict that goes beyond Iran's borders would cause quite a jump in oil prices. And then that's when we're talking about $100 Brent. Now, I want to preface all of this with no one knows exactly what's going to happen. And it could very well be that there is no attack on oil infrastructure. It's not necessarily in Israel's best interest to do that because they're an oil importer. So that would increase the price of their energy imports. But, of course, the Biden administration and President Biden himself said that that's something that's being discussed when he was doorstepped earlier this week. So all sort of scenarios have to be on the table, and that's what traders are watching very closely.
Right, and Stephen, to your point there, we've gone from 70 to 77, and that's hardly a doomsday scenario. To your point there, how much of the move we saw this week was simply the markets recalibrating for some risk on the table?
I think, a lot of this was probably short covering. I think people were unwinding their short bets because there were a lot of short bets, just these last few weeks because we're in such a bearish mood. OPEC Plus was meeting. They said that they were going to increase their supply increase later this year, which will add to a larger glut. U.S. inventories are rising at a faster pace. Even though there's the China stimulus, their oil demand has lagged what some people have thought would be stronger in the market. So all that together had been pushing this bearish mood. There were a lot of people in the market who were short. And when this, escalation, this war risk came, they just said, I'm getting out. I don't want to be part of this. I don't want to take the risk that this could escalate. And that's likely part of what we saw there. I don't think the market is exactly pricing in an attack on Iran's oil infrastructure quite yet. I think that there's an expectation prices could go further.
Stephen Stapczynski there in Singapore for us. So that's one event risk markets are having to deal with and discount going into the weekend. The other one is, of course, in the U.S. and U.S. markets with the release of the jobs report for September and estimates, in case you're curious what they look like, 150,000 non-farm payrolls, an unemployment rate that remains steady. And, of course, there is some variance and quite a range here as far as the estimates go. We're showing you the consensus. Average hourly estimates year-on-year, just under 4%. And, of course, month-on-month, slight tick lower from the previous month. The interesting takeaway, though, from Anna Wong and Bloomberg Economics is really, even if this does look good, it doesn't mean things are well and good.
Yeah, they had three reasons Powell is wrong about the labor market. I won't go into it in detail. Make sure to read it. But in terms of what she's saying is that a lot of these sort of COVID-related sort of stimulus and support that we said has basically distorted a lot of the data. So even if it looks solid underneath the hood, things do look a little bit maybe on the weaker side. For example, jobless benefits, she says, no longer track unemployment. Those correlations have basically broken down in some way. So that's just one example of what they're seeing there as well. And possibly maybe why this job support could determine whether we do does the Fed actually sneak another 50 basis point cut by year end?
Which the market somewhat still has
a little bit of hope on that.
Yeah, somewhat priced in, right? 33 basis points for the November 7th and 8th meeting. Let's put the question to Anitza Nip. Head of Asia Fixed Income Research at UBP, joining us here. Good morning and happy Friday. On the Fed, do you think markets are underpricing or overpricing the amount of easing that's coming?
I think a lot of things are priced in on the Fed action. Basically, people are, following the dot plot in the sense that, like, this year could be 25 to 50 towards year end and 100 in 2025. House view, basically, it's, thinking that 2025 it could be done. Fed fund rate could be reached to 3.5 to 3.75 from the current level. So I think, a lot of pricing into the market at the moment. So that's why you've been seeing some pressure on the Treasury yield recently. That the 10 years or even the 2 years do not go down anymore, simply because people are watching the data as well as what's going on, and I would expect situation would continue that the US Treasury could be range bound for a while.
I think most people are still thinking that soft landing is the base case. I'm guessing that's yours too, and it's
yeah, that's right.
Do I still focus on, I know you've always talked about IG is still the safe place to be. Are you venturing out of the quality spectrum? Do I look at high yield now too?
Okay, in fact, when we look at the Fed action and our sort of like forecast, we basically think that, the dot plot is like that, but the yield could potentially move a little bit higher on the long end next year. So that's why I think, it comes down to where should we put the money. IG is still, where we prefer, but at the same time, people can look at some short data high yield simply because we think that, you could come up from here a little bit. So credit spread we expect to be resilient. The main reason will be we are thinking about like a soft landing. And at the same time, you see Fed cut. China's stimulus measures also would help the liquidity in the market. So all these are basically supporting credit spread. So looking at IG or high yield, I think, both would be a good choices depending on the investor appetite. But what we prefer on the high yield side would be really, just short data. Just in case, we have a lot of like different events coming up, like, at the moment, geopolitical tension, US election and things like that.
Even though on the short, you look at short duration, things do look expensive, though. You think there's still enough carry there for
But the thing is, like, for short end, basically, it just helps you with the volatility. So that's also a reason why we, asking people to go for maybe like 3 years, extend longer into just 5 years maximum. The main reason would be, in this current market, pretty volatile going forward, you don't know what's going to happen. It would be good to really sort of, stick with something quality and also with less volatility.
How are you looking at the China stimulus? I think most people for the last few years have basically made real estate bonds something of more idiosyncratic. I've separated that. Is it time to kind of broaden the horizons a bit in the credit space?
Well,
in
the
China
stimulus actually is massive, isn't it? Like, look at it, it's like, very powerful. But at the same time, at the moment, we still would prefer to be sidelined on Chinese property bonds. The main reason would be because I think a lot of things still need to be resolved, including, for example, the deleveraging. The process could be long. Unsold inventories, is still a lot of them. When you look at the action in the market when the announcement came out on the stimulus measure, those who surviving, non-defaulted, they actually gone up by about like 5 points, 10 points. Right. I won't rule out the fact that these could go up slightly, higher going forward, because I expect basically the contractor sales would improve in the next few months. Otherwise, government would put up more stimulus, right? So property sales, could in short period of time, 3 months within this year, will go up. So these surviving property developer would benefit, and their bond price would, be well supported. But for those who defaulted, they are going into restructuring. A lot of them basically, unchanged after this announcement. So we think that in longer term, one thing that we, kind of quite sure would be the property price seems to be, found the floor. So whether it's like, going to rebound substantially, we just don't think so. So at this level, at least, it helped the developer to clear their inventory to have, like the cash flow comes in. So one thing that would benefit the defaulted developers would be if this continue, equity market on their shares gone up, those who restructure because they would, some of them would receive the shares of the company, then these equities would help with the valuations, to the restructure bond. So that could, help a bit on that perspective. But for the moment, we still prefer to stay sidelined.
Yeah, I was going to ask you, would you still consider the group on aggregate as distressed? Because I think the index is trading at 87 to about 90 cents. but you still have 40 cents, and you still have a bunch of 95, 96 cents. So how do we describe this group of high yield bonds?
Yeah, exactly. I think it's quite divided. Some of them are still in the index, but most of them are non-defaulted in the index. So that's why I wouldn't expect that will be distressed. But those already defaulted will be sort of to another group.
Okay. So what do you like in the China space, at least?
Okay, so I like China Tech. Okay, because they are the one that would really rich cash flow. We also like the SOE and also some of the sovereign names. Asset management company, okay, would be something we also look at. Those have, receiving those defaulted loans from the banks, asset management company. But then we have to worry about like the supply risk on that. So basically, IG will be something we prefer in China.
So I'm going through some of the names, the Korean names. Japanese insurers, we've talked about this. I'm curious about Hong Kong corporates. That's something that we've touched on every now and then the last couple of years. There's been some big news, of course, without naming names, of one specific developer recently. How do you think the risk profile for these developers has changed? With rates coming down, but housing prices still remain fairly depressed.
Okay. In fact, we've been recommending clients on Hong Kong corporate bonds, at the beginning of the year. That, turns out to be positive, right? But at this point of time, we reckon that the valuation sort of like fair. We understand that, they got bank support, which is very important. Going forward, I think, people holding the bond can continue to hold it. But at the moment, I just won't chase the market for those.
We had JP Morgan Asset Management yesterday saying when it comes to China rates, they've closed that long duration exposure. Are you looking at CGBs differently now too?
For JGB, right? CGB.
Yeah.
I think in general we will prefer just the moderate duration on the CGB. In fact, at the moment I think the bond market is like reflecting the stimulus measures and everything. So we just stick with just the moderate duration.
Okay.
Anything in Japan?
Japan, insurance company for hard currency, but for local currency, I guess, for BOJ, we still reckon that because they're still a few weeks away from the meeting, we won't rule out the possibility they may still go for a little bit of rate hike at this point of time.
Is that still a risk to consider, a rate hike? Because so far they've said
it's been a U-turn from the Prime Minister.
Yeah, that's right.
Look at the dollar again this week.
Yeah, that's right. But then because, again, it's still a few weeks away, right? And the inflation is actually one of the concerns that they have. Of course, they want to focus on, economic growth for not changing the hike, but we won't rule out the possibilities as well. Yeah.
Anitza, thank you. Anitza, their head of fixed income research Asia at UBP. Still ahead on the China show, look at the impact of China's stimulus package on the investment landscape. What does it mean for VCs and the like? We'll get insights from MSA Capital's Ben Harburg later on this hour. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Markets pay attention to one thing at a time.
It's all about that wage data.
Wages are stabilizing, and that's good news for the inflation story.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Are we losing dynamism in this labor market?
We don't have a jobs problem at the moment.
It all comes down to what the data says.
How important is that payrolls data going to be?
The September jobs report, today on Bloomberg.
Right, yields on the 10s, govies are concerned. As you can see, Japan is up a little bit, as with Australia, up about 4. It's a 10-year, though, which has been Treasury, U.S. Treasury to be more specific, that has been largely range-bound after the melt-up over the last week and a half or so. So we're currently, call it 3.8%, and that's ahead, of course, of the September jobs report that's coming through in a couple of hours or so. Speaking of the U.S. economy here, former New York Fed President and Bloomberg Opinion columnist Bill Dudley says he's been too pessimistic about the risks of a so-called hard landing for the U.S. economy. He was wrong, effectively, is what he said. He spoke with our colleagues Sean Farrow and Lisa Abramowitz.
my original view was that the Fed would be late to tighten monetary policy. Check. As a consequence, inflation would go up and the labor market would get very tight. Check. Then the Federal Reserve would have to tighten monetary policy a lot. Check. And the unemployment rate would have to go up at least a 0.5 percentage point, trigger the SOM rule. Check. But the SOM rule trigger doesn't seem like it's leading to recession. If you look at the GDP numbers, they've been very firm lately. Second quarter, 3%. Third quarter is tracking 2.5%. So even though I had the story right, it doesn't look like the conclusion is going to pan out. It's too soon to say for sure. That's why the labor market has so much attention focused on it. And I thought what was interesting, the summary of economic projections at the last FOMC meeting, they actually, in their summary of economic projections, they actually think that the downside risks to the labor market are actually greater now than the upside risks to the inflation. So they're worried about the exact same thing. And that's why tomorrow's labor market report is so important. If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question. And that's why the Fed cut 50 basis points a couple weeks ago.
I think a lot of people, Bill, share your journey in terms of changing views and not understanding which models are actually accurate this time around. What in your analysis makes you think that this time is different and that some of the classic indicators that traditionally have foretold recession no longer work?
I think two things are different. Number one, you had all these fiscal transfers during the pandemic to businesses and households. So business and household balance sheets are in better shape than they typically are late in the business cycle. For example, look at debt service costs for the household sector. It's still pretty low because people locked in very low mortgage rates during the pandemic. Second thing I think is different is that financial conditions have eased a lot even before the Federal Reserve cut rates. So financial conditions were at the most tightest about a year ago. And since then, they've eased a lot. Stock market up, bond yields down, credit spreads tighter. And so even though monetary policy is tight, when you look at the level of short-term rates, financial conditions have eased a lot, and that's supporting economic activity.
What's to say we're landing at all, Bill?
Well, that's a good question. I mean, I think, the Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. But keeping on that that nice edge, growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession. That's going to be tough to keep on that nice edge.
And that was the former Federal Reserve Bank of New York President Bill Dudley speaking with our colleague Lisa Abramowitz there. And if you are a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation, send us instant messages to our team, to our guests during our live programming. Check it out at TV Go. This is Bloomberg. Welcome back to the China Show. A quick look at some of the other stories that we're tracking for you today. Bloomberg's been told that online fashion retailer Shein is preparing to start informal investor meetings to gauge interest ahead of a potential London IPO. A source says a Singapore headquartered company is awaiting regulatory approvals in China and the UK. An earlier plan to float in New York was met with opposition from U.S. lawmakers. HSBC is said to be canceling some events and further curtailing travel as the bank's new CEO seeks to keep a tight lid on costs. Sources say it recently scrapped a summit of commercial bankers in India, as well as some other off-site events around the world. The bank has already slowed hiring and asked investment bankers to rein in their travel and expenses. Japanese home builder Daiwa House is in talks to invest about $500 million in U.S. property developer Alliance Residential. A source says the transaction hasn't been finalized and talks could still fall through. Arizona-based Alliance says it has developed more than 115,000 units, representing over $23 billion in invested capital.
Okay, nearly about 60 minutes into the cash market session in Hong Kong, mainland markets are still shut. As you can see, market direction has been changing quite rapidly, and the bulls are again wresting control of this market. We're up 1.5%. 8 shares are back above 8,000. In terms of market breadth, depending on which index you look at, it's 80% of the Hang Seng China Index up, about 75% of the Hang Seng Index. So broad-based rally, suffice to say. As you can see, Hang Seng Property Index up 1.5%. A look at some of these developer stocks. traded here in Hong Kong. Mainland China developers and those names there we go on your screens. This has become somewhat of a norm. Double-digit gains for Sino-Ocean and Sherma Property. And we're looking at a similar move as well, not to this extent, though, when you look at Hong Kong developers. And as you can see, turn the page, and there we go. Decent gains. There's CK Assets, long for 2.7% to the upside here. Some of the developers, mainland and Hong Kong, listed, of course, here in Hong Kong on the Hang Seng Property Index.
Yep, so certainly there is a sign that maybe after one day, it took one day, maybe of profit taking, and then investors and traders are like, I think I can get back in.
That was it.
I think I'm okay.
Yeah.
Can continue on. Keep calm there as well. This rally continues for another day here today. We'll have plenty more, including a market update as well as we wrap up, of course, this beautiful day in Hong Kong and this week. This is Bloomberg. All right, close to 11:30 a.m. in Tokyo here right now, and we're getting to that lunch break. We're still kind of dealing with what's been going on with dollar-yen, so we're practicing a little bit of strength come through here, but certainly this whole U-turn from this new prime minister, where he sees BOJ and rates going, has really kind of sent a lot of, I guess, conflicting signals of where the BOJ is going to be. Most people were thinking maybe we could still see that rate hike in December. I think now that's been pushed back to maybe January as well. The Nikkei 225, we're still seeing some decent gains, but it's been pretty slow going. JGB yields, though, are following what we saw with the moves in treasuries overnight. We're up some 4 basis points right now. But yeah, the yen,
I know. And, the timing, I was just in Japan and when I was there, it wasn't this week. And then I come back to Hong Kong, and it's now the worst week for the Japanese currency in 8 years.
You always miss out on...
Talk about timing. You guys should use my travel schedule as your forward-looking indicator whether to buy or sell an asset. In any case, of course, there we go. 3.5% up on dollar yen. Something also, and speaking of this reversal, so we opened lower. We're now higher, 1.7% on the Hang Seng Index. I think the HS Tech Index is up now about 3%. So to borrow and sort of bend. What was that song from Les Mis? One Day More? One Day Only was what they needed. Or was it one more day? One day more. It was one day more. One day only was what?
One night only is another song, maybe.
That was Miss Saigon. Was that?
No.
No.
Dream Girls? I don't know.
One Night in Beijing. That was great. You guys remember that? Anyway, 3% higher on the Hang Seng Index. All right. So what's happening here? Let's bring in Krathing Nai, of course, with us here on set to talk us through. It did look weak at the start of the session, and yet here we are, wrapping up the week on some fairly solid footing.
Absolutely. Yeah. It's been, what a wild week it's been. I can't believe we're, all sitting here looking fine and alive and not falling over on a Friday. I think there's just a lot of reconsideration right now, reassessment. I mean, it is, a battle of both sides, right? Tons of banks and brokerages will come out to say, hey, we're worried, 2015, this could be the bubble bursting, be wary, buyers beware, caution, lots and lots. And then you have people on the other side saying, hey, this is great, this is the time to buy, this is it, this is the golden opportunity, once in a lifetime, right? It is a clash. People are kind of wondering, is this time to get in, time to get not, or not? I think the next sort of major mile marker here will be on the consumer data coming out of Golden Week, right? I mean, we've seen the data is a little bit lagged. We've seen a lot of state media kind of already point to amazing numbers, and it's still, one or 2 days lag, so we don't really know. Citi coming out this morning to say that the travel numbers look resilient, but there's not a lot of upside surprises. We will see how it goes. Some of the consumer names this morning, Hidalgo, Trip.com, doing well, so there's obviously some optimism, but we'll really need to see that follow through in the figures for this market to really kind of hold on and to see sort of something to bite into, so to speak.
And there are still some people out there that are willing to kind of pour some cold water on this rally, right? We talk about GQG, Nomura. Tell us a bit more about these bearish calls.
Exactly. I mean, I think that with anything this epic, right? Whatever superlatives you want to say, there's going to be that concern. I think that a lot of people are saying, hey, the economy is just not as strong as what we've seen. I mean, people are comparing it to 2015 for good reason, right? This was similar in terms of the excitement, in terms of, I mean, maybe not yet in terms of leverage, and we're not quite there, but the economy now is not as good as it was back, years ago. And people are definitely nervous. I mean, that makes a lot of sense. But, yesterday, HSBC here upgrading Chinese equities, BlackRock also earlier this week, upgrading their views. And it's an interesting time. There's a lot of really strong opinion out there.
All right, Catherine. Thank you. Catherine Nye there, who leads our Asia stocks coverage. Joining us now is Ben Harburg, managing partner at investment firm MSA Capital. He's also a portfolio manager at Core Value Alpha. And he's in town in Hong Kong. Ben, it's good to see you. Once again, I think it was a month ago, we were just talking about how bad sentiment was in the VC world, where you said live flat sentiment was at extreme lows, limited capital, limited sort of growth here. Have things changed really dramatically in the last few weeks, you think?
It has. It's, I think it was because people weren't convinced that the Chinese government was going to take robust action. We thought it would just be a continued trickle of mini stimuli and, and a feeling that the government thought that they could muster their way out of this organically. And this is the first time when we felt this sustained, robust, momentum-building push from the government and oftentimes breaking rules. For instance, cash handouts, which they said they'd never do, and some of the other actions that cause us to believe that this is a break from the traditional approach the Chinese government has taken, and that is causing a really a bit of shock and positivity in an overall negative environment.
What are you hearing on the ground, though, from whether portfolio companies or your network in China? How have things? What are the changes they're looking for over the short term because of what's been announced?
They're hoping that this creates a virtuous cycle, right? So that people seeing their equity values going up means they feel a little bit more comfortable about spending. There's that $21 trillion worth of household savings stored up, and we're waiting for that dam to break, and that can flow both into the public equities as well as into domestic consumption. And that is really what could kickstart this. So we should think of what happened over the last 8 days really as more of a return to rationality in some ways, so less of a bubble, less of kind of a GameStop type spike, and also hopefully as a jump start or kickstart to the engine of the economy to restart some of that consumption. We won't see it immediately. I mean, obviously there might be a little bit better spending out of Golden Week, but overall I think we're hoping for that 2-3 quarter jump start.
Yeah, you mentioned last time some of the new trends that emerged was that there was this whole focus on overseas expansion in some of the companies. And do you think now that we've seen more stimulus, is it looking more inward and more looking at this domestic sort of inflation story more?
The outward expansion was essential because you had the flat domestic economy. And so if companies were hoping to show better numbers and higher margins, they were going to have to go abroad. But there's a risk to that. Obviously, China became such a big net exporter that everyone in the world eventually was going to go into a trade war dynamic with them because they didn't like that trade balance. And so the true sustainable growth for China also has to be developing their domestic economy, domestic consumption. And that's where unlocking that $21 trillion is so essential. We need people buying more expensive domestic products and building more expensive homes and growing out of their current stasis, and that's where hopefully this will start that growth.
Does it change necessarily how you think about your own investment strategy in China?
So we've been bulls for a long time. We started an ETF a year ago at what we thought were bottoms, and picked all of the kind of blue chip names that we thought would be the first line getting investment when something like this were to occur. So we're now hanging on for the ride, and we're adjusting our portfolio literally day by day to try to grab as much of the upside as possible, shifting between A share, H shares, and the ADRs. But hopefully, this also starts to bring private capital back to the market on a longer-term basis, and that's what we're waiting for.
Do you see any sort of markets that would come at the expense of all these inflows coming back to the Chinese market? I mean, everyone's been talking about Southeast Asia or even South Asia, like India. Are you taking some profits in those markets now?
Absolutely. I mean, certainly there was a narrative, and it was partially driven by returns and partially driven by geopolitics, that we should look for, that global, particularly Western investors, should look for alternatives in, say, Japan, India. And I do think that there's a bit of a mirage that grew in those markets. India became very inflated, some of the highest PE multiples globally, with still a lot of kind of worrisome underpinnings to it, a challenging kind of domestic political landscape, a lot of crony capitalism, a faltering altering VC landscape where two of the three biggest VC-backed companies have folded. And so I do think there was a bit of irrational optimism about China, about India at the expense of China. And hopefully this returns people to that rationality. That's why you're seeing a lot of New York-based hedge funds saying, go all in on China. And I think that shows you that geopolitics is less relevant. It's really just returns. If you can get the returns, you'll come back to China.
I mean, the hedge funds coming back in, it's not a surprise. It's the long-only funds that we're waiting for. When do you think we get that concentric circle coming in? That Venn diagram, as they say, that the incremental buyer to this Chinese equity market that stayed away.
We've got to see this sustained momentum in the upward trajectory on the public markets. I think people were waiting for the shoe to drop. They were waiting for the crash. We saw a little bit yesterday in Hong Kong. ADR is down a bit overnight, of course. And so I think people are expecting this to run out of gas, that the Chinese government can't continue to release new edicts and new stimulus policies. And so the hope is that maybe we see positive numbers out of Golden Week, of course, and then some of these companies start reporting consistent, albeit strong fundamentals as they have been, and then that kind of starts to draw back in the bears and skeptics.
Okay, so looking more at the fundamentals, is there anything in this market you think that looks quite mispriced right now?
Well, the entire China market to us looked mispriced. I mean, you had companies from Hong Kong, say, trading at their, the book value, or if you had companies in China, say, a Pinduoduo that was growing at 80% a year, but was at a 9 to 12x PE multiple, and you compared that to Amazon, which was at 45. I mean, this just made no sense. And that's, again, why I say this isn't a GameStop bubble. This isn't people irrationally valuing these companies. This is people finally starting to look at the fundamentals of these businesses and saying, wow, these are good companies, and they didn't deserve to be priced where they were, and they were priced that way because of a lot of negative headline risk and geopolitics and regulatory rumor, but not truly around the fundamentals of those individual businesses.
Yeah, I'm glad you brought it up. A lot of the comparisons recently, because of how cheap the entire market had become, was against a historical norm. And I'm wondering, because the economy has changed, the growth rate has changed, should we still be attaching, say, at 12 times PE on China, or is that sort of naturally evolved lower?
We're certainly we're much closer to being a mature economy than we are an emerging economy. The growth rates, though, are still always going to surpass the U.S. for the foreseeable future. Right. And so I think people gravitated towards the U.S. markets just because the returns were incredible. I mean, the S&P was up 20+% this year, and China was flat. Why deal with all the headline risk and regulatory concerns and geopolitics if you can get, outsized emerging market type returns from a Western stable market? Hopefully now that, companies that the Chinese market is outperforming the U.S. Our ETF, for instance, was one of the top 10 performers in the world last week. People will start to kind of come back and reevaluate these businesses on their individual merits and recognize that the risk-return profile is not as extreme as they thought it was, and you can get great returns on what is a market that's easily going to be the world's second biggest indefinitely. In a growth environment that's still higher than what you get in the West.
You sound very optimistic, Ben. So I'm just wondering, is there any risk that you're looking at right now? I mean, is it still about fiscal spending and whether they can actually deliver on what people are expecting as a big fiscal boost?
So I'm optimistic just because we finally got a little bit of good news, and it's been so many years of bad news that we will take what we can get. Yeah. Certainly, the Chinese economy has all kinds of growing pains to go through. We've got to figure out a way to grow without focusing on infrastructure spending and get out of this whole real estate malaise and shift those people to knowledge-based industries and more kind of higher-end technologies. So, definitively, we have a long way to go to evolve the economy. And again, a lot of these Chinese government policies are not going to have any true impact, right? It's more of the narrative than it is the individual impact. For instance, if you unlock consumer credit, people don't want it. They don't need it. So it doesn't mean that people are going to spend more just because it's available. Yeah. So it's got to be kind of these incremental measures that create that positive momentum, that people start spending both in the domestic stock market as well as internationally, and of course, buying things locally. And that momentum then can build into something over the next couple quarters that will look better.
You've mentioned you guys are almost daily adjusting your exposure and your holdings. So what are your biggest overweights now?
We've been much heavier into the ADRs. We feel, we at the offset, we were heavier into the A shares because we know that those would lag the Western indicators. And so we tried to mop up as much as we could during those first few days of the jump in the A shares. Now we've migrated back to the ADRs again because we see that volatility in the A shares. And so we've kind of gone back to our, fortress positions in Pinduoduo and Tencent and other names that we feel like have, again, solid fundamentals, but are also, going to attract a lot of that Western capital as it starts to take a second look at the market.
Mainland China reopens on, is it Tuesday?
Tuesday.
How do you think the market's going to open next week?
I expect it to open strong. I mean, I think people have been kind of watching what's going on, and feeling, again, this increased sense of optimism. And obviously we've seen a huge amount of pent-up interest in the market. I mean, again, you just look at the indicators in the Chinese public markets. For instance, there's only single digits of interest from large pensions and state sovereigns, whereas in the U.S. it's over 30%. Only 30% of household investments into the public markets, relative to about 70% in the U.S. So there's huge appetite for these markets if the people can start to feel that there's money to be made. So I expect it to come back strongly.
Ben, thank you so much. Nice to see you. Ben Harburg there, managing partner, MSA Capital portfolio manager at Core Value Alpha. Just a check at markets while we were having the conversation, a further pickup in equity prices here in Hong Kong. As you can see, extending these gains. It's almost as if someone dropped a happy pill in the water about 30 minutes back. And here we are, 22.5 on the Hang Seng Index. Plenty more ahead. You're watching The China Show. Happy Friday.
We do not think that tariffs are a good idea. And of course, our automotive industry is still exporting very heavily to China, so that we are evaluating the Commission proposal at the moment. But yes, you are right in saying that Germany does tend to be skeptical about the imposition of tariffs, and this is no exception, but we have not decided yet on which position to take for Friday.
France supports the implementation of this new tool that is basically a response to excessive subsidy regimes that China has used in order to establish dominance in the field of electric vehicles that might threaten our own EV industries.
There we go. The German Chancellor's chief economic advisor and also the French foreign minister taking, as was quite stark there, opposing positions ahead of this crucial vote in the EU on those tariffs on Chinese EVs. Now, that vote, of course, happens later on Friday and, later today, with the proposed tariffs as high as 45% on some of these imported models coming made in China, at least. Our China correspondent, Min Low, is here with us to talk us through how could the vote go.
Yeah, you just heard very different views earlier, and European officials, we know, were pretty confident that they have enough votes to push this through, but then they were also a bit cautious about making any predictions, especially after the Spanish Prime Minister Pedro Sanchez had basically reversed his position after making a visit to Beijing. And Germany as well has been, the last time they had abstain from the vote. This time, Reuters is reporting that they could oppose the vote, but the bar is very, very high because China needs a qualified majority of 15 member states that represent 65% of the EU's population to vote against this proposal in order to get it averted. And so far, we have never seen any sort of EU trade measure being overturned in this way before. We have heard from the CEOs of Volkswagen, Mercedes as well recently, just putting pressure on their government to be very cautious with this tariff because there are a lot of concerns that China could retaliate, right, with maybe tariffs on those vehicles with large engines. And these German car companies, they make about a third of their sales from China. And the Chinese Commerce Minister Wang Wentao had been in Europe, not too long ago, just on this whirlwind trip to try to convince the European partners to reverse this proposal. Hard to say how it could go. If it does go through, the two sides at least have still agreed to continue those talks even going forward.
And if it does go through, what impact could a yes vote have?
Yeah, so by some estimates, it could cut Chinese exports to the EU by as much as 25%. Although some analysts are saying that if you look at the first 4 months of this year, the sales for companies like BYD, SAIC, in terms of their sales to Europe, that makes up only about between 1 and 3% of their overall sales. So maybe that impact is not so great. And also you have a lot of time to prepare for this moment. And many of these companies have already been, scouting for locations to open up plants in the EU to bypass the tariffs. Chery, for example, looking to open a plant in Spain, BYD in Turkey as well. And they've also been looking to diversify their markets as well, looking to export to Southeast Asia, for instance. But of course, the bigger concern is not just the fallout within the EV sector, is the broader fallout if it gets into a tariff war, right, that could involve the agricultural sector and other sectors as well.
Min Lo, thank you, our China correspondent there, as we await that vote in the EU as well. We got plenty more ahead. This is Bloomberg.
Right. As we look ahead to, and I think before we make that hop into the weekend, there's that little thing, of course, of this U.S. jobs report that's coming out. And certainly with the conversation around, does the Fed need to do another 50? Do we need to look beyond the numbers itself? And you can read about and have a look at the consensus right now. I mean, certainly some of the commentary comes in, and again, we've been pointing back to this note and highly recommended, I encourage everyone to read it, Bloomberg Economics and Anna Wong and her team, because they really break down where they think the attention should be. So we have likely a decent jobs report if economists are correct, but they see underneath the hood it doesn't really mean a robust labor market as well.
Yeah, it's interesting that she mentions about the three reasons, but they're still expecting, watch very closely the unemployment rate, right? It's unlikely it could be unchanged, but they're still thinking it could tick higher here. In fact, they still think that unemployment rate could hit 4.5% by year end, 5% in 2025. So, just because you're getting a solid jobs report, it doesn't mean that the unemployment rate cannot rise. Yeah. That's what they're saying. And that still puts that 50 basis point cut on the table.
Yeah, coming through in November. And I think you're right, because some of the statistical aberrations from the pandemic, number one, there are many people who have taken on multiple jobs that get double counted, I think, is one of the other things she's pointing out. So, yeah, it's not just the numbers itself. But at any rate, just to shorten that, summarize that as well, the path of the direction of travel seems to be that this is a soft jobs report that might merit more easy coming out of the Fed.
Yep. Of course, you can turn to your Bloomberg for more on this as well. T-Live is where you're going to go to get commentary, analysis from our expert editors as those numbers drop later on today.
Okay, a brief look at some of the sectors we're tracking and really big moves across these on the back of, again, this rebound in equity markets. That's number one. Number two is oil prices moving up. 8% move in West Texas and Brent this week. Biggest weekly jump in 19 months in oil prices, and we have a full trading day left. As you can see, it's playing out across some of the energy names here listed in Hong Kong. Some of the other names as well, Alibaba Health, which was a very big winner and still is right now one of the best performing stocks in the Hang Seng Index since this rally began, up 6.6%. You're getting a lot of moves, though, as far as some of the AI plays and some of the chip plays are concerned here.
Yeah, staying on the tech conversation, it's interesting. Sami Chan from the China stocks team is talking a little bit more about there's a lack of short covering in the China tech space this time around. So if you look at some of the short positions around Alibaba, JD, and Baidu, they basically have stayed stable. When we saw HS Tech up more than 45% in less than 4 weeks, what does that tell you? Maybe there is some signs of fresh buying here. This is not just a short covering story here right now.
Yeah, some fresh incremental flows coming into this market. Again, that's a very good point. To answer the question whether or not what part of this is short covering, Some of the consumption-related plays, we are, of course, still in the thick of Golden Week, so we are getting incremental data coming through, although it's still conflicting. I think Citi came out with a report and saying they are getting an encouraging set of numbers, high-frequency data, although I think some of the other data that's come through in commentary pointing to...
A few upside.
There.
They're from Citi. But you take a look at when it comes to biotech. We're watching WuXi AppTech and WuXi Biologics, for example, here. So this is according to the FT. They're looking at potential sale of some of their businesses and operations there. Plenty more ahead. This is Bloomberg.